Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome, listeners, to another insightful episode of Tax Smarts Unlocked. I'm your host, David Robson, ready to guide you through a fascinating exploration of investing and the tax implications that come with it. Investing wisely isn't just about picking the hottest stock or making a quick return. How you handle the tax side of investing can make a significant difference in your overall financial picture. Today, we're going to unpack the complexities of investment strategies for both business owners and individuals, shedding light on how these choices impact your taxes. First, let's talk about why understanding the tax implications of your investments is crucial. Investing is exciting, full of promise for growth and expanding wealth. But if you're not cautious, taxes can quickly eat away at those hard-earned profits. Taxes are, after all, one of the few guarantees in life. The aim here is not only to maximize your returns, but to ensure that you're preserving as much of those returns as possible by minimizing your tax bill. Imagine you've made a considerable profit on an investment, but come tax season, a substantial chunk goes straight to the tax man. By planning and understanding your tax liabilities, this scenario can be avoided, or at least mitigated. Now, let's break down some of the investment options and their tax implications. When you think of traditional investments, stocks and bonds usually come to mind first. Stocks, for example, can provide excellent returns, but the tax treatment can vary significantly, depending on whether your gains are short-term or long-term. Short-term gains, those held for less than a year, are taxed as ordinary income, which could be a much higher rate than long-term capital gains. Long-term capital gains, held for more than a year, benefit from a lower tax rate, making it a more favorable option for holding investments over time. On the other hand, bonds can serve as a steady, reliable income stream. However, interest income from bonds is typically taxable at your ordinary income rate, unless they are tax-exempt municipal bonds. For some investors, the stability of bonds offsets the potentially higher tax cost, but others might find it less appealing. Each type of bond, government, municipal, corporate, carries different tax implications, and understanding which fits best with your tax situation is crucial. Then we have real estate, a favorite among many investors for both income and capital appreciation. Real estate investment offers unique tax advantages like depreciation deductions, which can sometimes offset rental income. Plus, if you sell a property at a gain, primary residential properties have an exemption threshold, which is quite beneficial. However, watch out for capital gains taxes on other real estate investments, which can add up quickly if not properly planned for, particularly if you're engaged in flipping properties holding them for less than a year. Mutual funds are another significant category, particularly popular for investors looking for diversification with less direct management. However, mutual funds distribute dividends and capital gains which are taxable to the investor. It's essential to understand when these distributions occur and how they affect your annual tax return. Choosing funds with a tax-managed approach could mitigate some of this liability and help maintain more of your investment returns. Next, let's dive into capital gains tax, a crucial concept for every investor to understand. Capital gains tax is what you pay on the profit made from selling an asset. The key here is the holding period of your asset, which determines whether it's taxed as short-term or long-term. As I mentioned earlier, long-term capital gains enjoy a lower tax rate, incentivizing you to hold on to investments longer. However, balancing tax efficiency with your investment strategy can be tricky. Sometimes an early sale aligns better with your financial goals despite the tax cost. Consider also the benefits of using tax-advantaged accounts like IRAs and 401ks for your investments. These accounts offer significant tax perks by allowing your investments to grow tax-deferred or even tax-free, depending on the type. Contributions to a traditional IRA or 401k can be tax-deductible, lowering your taxable income for the year. With a Roth IRA, although you pay taxes on contributions up front, the withdrawals in retirement are tax-free, a great advantage if you expect tax rates to be higher in the future. Enhancing our discussion, let's consider some real-world case studies. Suppose we have an investor, James, a small business owner who primarily invests in stocks. By consulting a tax advisor, James learns he's been overly focused on short-term gains, significantly impacting his tax bill. By shifting some of his strategy towards long-term holdings and taking advantage of tax-advantaged accounts, he manages to reduce his taxable income and retain more of his investment profits. Another example is Sarah, who invested heavily in real estate. By exploring 1031 exchange options, she managed to defer her capital gains tax, allowing her to reinvest her profits fully. Business owners have unique considerations when it comes to investing. Their overarching goal is often to maximize returns while minimizing tax burdens. They might look into investment strategies that align with their business cash flow needs. Tax efficiency can also be achieved by strategically timing capital expenditures or taking advantage of Section 179 deductions for equipment purchases, affecting taxable income in ways that align with their investment and business objectives. For individuals, determining whether to focus on short-term or long-term investments is a common consideration with significant tax implications. Short-term investments might offer higher potential rewards, but also come with the higher tax cost of ordinary income. On the contrary, long-term investments are taxed more favorably and are often recommended for those who are not in urgent need of liquidity and can afford to ride out market fluctuations. Let's consider some strategies to minimize your tax burden through smart investment decisions. First, tax loss harvesting is an excellent method where you deliberately sell losing investments to offset the gains from winners. Another approach is maximizing contributions to tax-advantaged accounts each year. Also, consider the timing of your asset sales and distributions carefully to manage your tax liabilities along with your overall investment approach. Using foreign tax credits and exclusions if you're investing overseas can also be helpful. It's vital to recognize the invaluable role a professional tax advisor plays in optimizing investment strategies. The tax landscape is a complex maze, and what holds true today might not be the case tomorrow due to ever-changing laws and regulations. Tax advisors provide expert guidance tailored to your specific situation, ensuring that your strategies not only align with current laws, but also anticipate future changes that might impact your tax position. They're your allies in crafting a roadmap that navigates tax hurdles while presenting opportunities for smarter investing. Finally, it's crucial to regularly review and adjust your investment portfolio with an eye toward tax efficiency. As your life circumstances change, be it changes in income, new financial goals, or shifts in the market, so must your investment and tax strategies. What works for you today might not be as effective tomorrow, so periodic reviews and adjustments are key to maintaining optimal tax efficiency. So as we wrap up this episode of Tax Smarts Unlocked, remember that investing wisely isn't just about selecting the right assets. It's about understanding the tax consequences of your choices and integrating them into your overall financial strategy. We've covered a lot of ground, from different types of investments to tax-advantaged accounts, real-world case studies, and the importance of professional advice. The goal is to empower you with knowledge and strategies that help you reduce your tax burden and achieve your financial goals. Thanks for tuning in, and remember to keep your tax game strong and your investment portfolio smart. Until next time, invest wisely and stay tax savvy.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.